accounting for inventories. And in this module, we will learn something very important, that when inventories are recognized as expense, we know very well that inventory is an asset. Okay, by its definition, inventory is an asset. And when this inventory is recognized as an expense, this is what we will be learning in this module, so your attentions are required. Okay, so let's see, there are three scenarios. Number one is the inventory, we have sold out the inventory. Whenever we have sold out the inventory, the cost of that inventory will be recognized as an expense. And what is the name of that expense? Cost of goods sold. Okay, well, and the second is the amount of any write down of the inventory to its net realizable value. We had a cost of inventory. Its net realizable value is lesser than the cost of inventory. So the difference will be expense. Okay, the inventory is not sold. That is still with us. Its loss of value because of the lower net realizable value will be taken as an expense. And the third thing is that loss of inventory because of any accident, theft or fire, etc. Okay, so these are the three reasons because of which the inventory, which is in fact our asset, is recognized as expense. Well, let's see an example. It's practice question where Sumayya is engaged in production of surgical items. Following data is available for the month of March. Okay, the opening stock with her was 3,000 units at 100 rupees per unit. And she produced 30,000 units at rupees 100 per unit. And the closing stock in her inventory is 2,000 units, again at 100 per unit. We did not change the cost per unit for the sake of ease to understand the concept. Okay, so how we will work out the expense charged to the income statement based on this information? So the thing is that total 3,000 were in the inventory, 30,000 were produced, so 33,000 were the number of units available to sale. Out of which, if 2,000 units are still with Sumayya, so it means that she has sold out 31,000 number of units during that period. Okay, well, so the cost of goods sold, which will be recognized as expense in that accounting period, would be 31,000 times this cost per unit, that is equal to 3.1 million. Okay, so this is the cost of goods sold which will be recognized as expense. Now let's see an example where Hamza has following data for the month of March. Opening stock is 300 units, purchases are 1,000 units, and closing stock is 200 units. Okay, well, so the thing is, on 31st March, NRV of the product comes down to 95. What we will do? Now, these 300 units are the opening inventory times 100, 30,000. Either we are working it out at NRV or we are working it out at cost. Opening inventory is this, and the production or purchase cost is 100,000. Okay, so total cost of goods available for sale was 130,000 in both cases. All right. So what happened? That closing inventory under this NRV would be 19,000. This 200 units times 95 is 19,000. And if we work it out at cost, it will be 20,000. And if we work it out at cost, it will be 20,000, means 200 times 100 will give us 20,000 cost of inventory. All right. So the important thing to point out over here is that when we are reducing the value of our inventory based on NRV, the cost of goods sold has increased. Okay? And if we are not reducing the closing inventory, the cost of goods sold is 110,000. So this is something you can say automatic, that if we take closing inventory at a lower amount, the cost of goods sold increases. So in a way, 1,000, the difference of these two items, we just took this as an example, that the difference of 1,000 is being recognized as an expense in cost of goods sold. Okay? So this is how we see that our expense figure is recognized, okay, under this NRV system. So main thing is that cost that expires is expense. Okay? Either we have sold it out, the cost of inventory expires, or the cost is no more recoverable. Why? Because the NRV has been reduced. We cannot recover the cost. So the amount that has been lost, expired, is expense. This is the tip. So thank you very much for your attention.